What song are you playing?
I'm playing a song in my head, baby. Welcome to the Everything Money Weekly live stream. Paul, we're doing this. This is our third week in a row, third or 4 weeks. This is incredible. We are going live. Did you hear me just say getting?
I heard.
We've been getting so much. We have gotten so much support out of you. I'm just going to say guys now because we have like 3 women watching us. We love you, 3 ladies. It's my mom. It's Paul's wife. And I'm sorry, not Paul's. It's Don's wife and my mom and my wife are watching.
I don't have a wife.
But thank you for the support. We get so many comments. Our most favorite one, Paul, is why don't you guys have 1 million subscribers yet? And the answer is because we need your help. So go ahead and share this video real quick with a friend of yours who's never heard of us, who loves investing, finance. And if they'd love to argue with Paul about Tesla, he'll do it till the cows come home. But welcome to the Everything Money Show.
Can we give the people what they really want?
Oh, my God, Paul.
The shorts.
Paul has now other comments we've been getting is how Paul's shorts are just off the hook, off the chain.
I don't know how this became an obsession. It was just always me in workout gear. And so today I decided to wear my University of Michigan shorts. I have another pair that's blue with the tan Michigan M. So these are pretty solid. No, it's yellow. I don't remember.
Both are very effeminate, and your camel tail is prominent, and it's just wonderful. And so what are we doing today? I'm going to cut the BS and get right to it. As always, we analyze all forms of money growth, stocks, investments, real estate. But you guys have been asking for businesses. You've been asking for more stock analysis.
A ton.
Uncle Paul uses his 8 pillars of looking at a company. Now, I'm telling you, if you're new to this channel and you've only ever looked at the price, be interested in Tesla, Amazon, all these popular ones, Paul will go 8 pillars of really the health of a company. I'm telling you, something that's normal people have never come across. Profit growth, PE ratio. These numbers are confusing to someone like me, which is why I'm here asking your questions to Paul.
We get a lot of engagement from people throughout the week asking us to analyze certain stocks on the live stream. And I just tell them, hey, get on the live stream. We're going to do a few stocks today. We're going to do 3M. We're going to do DraftKings. DraftKings was a request. And then somebody requested this morning, Broadcom. So we're going to give that one a go. So first, let's start with 3M. How does that sound? Let's get right into it.
That sounds great.
Subscribe, all that crap.
Yeah, make sure you smash that like button. We have people joining right now. Some OGs, John Thiesing, our dear friend.
I don't believe it's John Thiesing.
Well, we've been corrected, but he's on, and I love you, John. And as always, we have viewers from all over, somehow the world, Paul. These shorts are making their around the world. We have someone from Maui, which I think
Maui's not.
It's south of Jersey, I know, but but all over the world, people are watching. Now, here's what we're gonna do.
Jersey.
I have a special place in my heart for 3M. I love tape. No, I'm kidding. I have a side company with Paul's tutelage and help, and a partner of mine whom I love. I bought a side company this year, and we make spray graphite film. It's a long story, but it's like a spray lubricant. And 3M is one of our companies who've been buying from us for a long time. So I love this company. Don asked me if I hold stock in it. I think I might. I have to look at my portfolio. I'm so diversified, Paul. But anyway, it's an interesting company, and I want you to look at it and let's start. What do you think about this company? What do you know about 3M?
All right, so we're gonna do the 8 pillars, correct?
8
Where
pillars.
are they based out of? Minneapolis? Yeah, it's Minnesota. So Minneapolis, I think, is a company.
Okay.
They're huge. They're one of those, like, you call them like a blue chip, essentially. I mean, they're just such a big company, so many different cash flows, et cetera. So what's the first one, Seth?
Pillar number 1 is PE ratio less than 20. This is price to earnings ratio. We want it less than 20.
What do we have here?
18.5. I love it, Paul. PE.
How does the size look, Don? You don't want me to make it bigger? Okay. So the PE ratio off the dribble, less than 20. So good start. We have a nice little green check mark. Did we already do the green check mark?
Pillar number 2, pillar number 2 is profit margin over the last 5 years, Paul.
Profit margin over the last 5 years? How about just profit margin in general?
Sorry, profit margin.
Number 2. This one. What do we have here?
What is it, Paul? Tell me. I can't see.
18%.
Oh, snap.
So it's perfect. We want it to be over 10. Now, remember, profit margin isn't the be-all and end-all. You're not sitting there saying if it has 3%. Walmart, they don't have Walmart, Amazon, they don't have big profit margins, but they make a ton of money. But I just like seeing that. And it's one of those that's not as important, but I like seeing big profit margin. Also, their gross profit, which means for every dollar more they sell, how much do they make for every unit they sell extra, how much that's profit? 47%. which means if they sell another $100 worth of product tomorrow, they bring $47 to the bottom line. So that's really solid.
2 green checks. Pillar number 3 is revenue growth.
Okay, so big company like this, you're not going to expect big revenue growth. It's been around for so long. It's so big.
Tell me that again.
You're going to have single digits, is my guess. I haven't looked, though.
Okay, go on.
And Uncle Paul was right.
Uncle Paul is right.
30.2, 30.1, 31.7, 32.7, 32.1. So it's up, not up a lot. Very low single-digit growth. Not great. Not. It's still a check mark, but it's not phenomenal. But you shouldn't be discouraged by this. I know everybody out there wants to buy fast-growing, sexy companies, but the slow growth ones are the ones people ignore. Therefore, the prices go lower. You might be able to buy better value.
Yes, people want Tesla. They want fun batteries and cars. This is like an adhesive company, right? I mean, this is the opposite.
They do a lot of BS.
Number 5, we want number of shares outstanding. We want that decreasing.
What about profit growth?
That's not do profit growth. Sorry, what about profit growth? My apologies.
Attention.
Profit growth under revenue growth. Pillar number 4 is profit growth. Sorry, it's my first podcast, everybody.
4.8, 5, 4.9, 5.4, 4.6. So this is an X technically. I don't really think it's a terrible X. It's very consistent. You look at the previous 5 years, 4, 4, 3, 4, 4, 4, 6, 5. So they're very consistent in between 4 and 5 range. So it's an X from the standpoint of growth, but it's not an X from the standpoint of it's very, very consistent.
Yeah, people are commenting that they don't, we're against sexy companies, but not sexy shorts. They are loving the shorts, Paul. They're really into that. Okay, pillar number 5 is number of shares outstanding. We want that going down, Paul. If they're selling shares, it means the value of your share is going down.
Yes.
I said that right.
You're getting less of the company as they increase more shares.
So we want the number of shares going down. Talk about
714, 708, 694, all the way down to 577.
Amazing.
So this is good. This is a definite check mark, which means they're probably taking their free cash flow, buying shares back from the public. So they're rewarding current owners by decreasing the number of shares outstanding and giving more to the owners. I just dropped my marker.
How about assets? Pillar number 6 is current assets greater than current liabilities. So we want money in the bank more than what they owe.
Okay, so we're going to go to the most recent quarter. Current assets, $14.1 billion. Current liabilities, $7.2 billion.
Double?
Big, massive check mark, folks.
Wow.
They have over double what they need to cover their current bills. That's a good thing. Now, again, with current assets, you want to make sure that inventory is a big chunk of it. We'll get into that later, but the bottom line is it's still a check. I like seeing this. It makes me very happy. It makes Uncle Paul very happy.
Pillar number 7 is free cash flow growth. Free cash flow, for all of you out there who don't think I know what it is, I do. And I'll tell you what it is after I think about it for a moment. Free cash flow is cash from operations, all the money they're getting in, versus minus capital expenditures. I almost fouled that up, but I didn't because I'm your host. I'm handsome and I'm amazing. This is free cash flow growth. What do we got, Paul? Uh-oh, Paul. Oh, no.
What do you mean, oh, no? 5, 5.2, 4.7, 4.9, 5.3. Still a check mark.
Okay.
The average is around 5. Call it 5.1. So let's call it 5 as the average. All right, not bad. I mean, and by the way, we saw the revenue growth. We saw the profit growth. It was very steady. This is expected. This is consistent. I like that. It's just very simple and consistent growth. That growth, consistent, what's it called? It's just steady. It's steady, and these things are not sexy. When things aren't sexy, people don't want them. Price stays lower. You can buy more cash flow for it. So the average is 5. So it goes to the next one. We want the average over the last 5 years of price to free cash flow to be less than 20. So if their average is 5, we want their company to be worth less than $100 billion, because 5 billion times 20 is 100 billion. We want the company worth less than $100 billion. So,
oh boy,
we're going to go back and see where it currently is.
900 billion.
Oh,
what is it, Paul?
$95 billion.
Oh my gosh, just listen.
So we have a check mark there, guys.
So
we have a lot of check marks in this company. What were the only, and the ones that were X's weren't big X's. They were pretty reasonable X's. You know what I mean?
Uh-huh.
So we have good check marks. This is great. I'm liking this. I'm not telling you to go out and buy the stock today, but here's another thing. Look at their dividend.
What are you burping up?
My Coke.
Diet Coke. Go on.
3.6% dividend, guys. And it looks like a very consistent dividend.
So to recap, the PE is 18. The profit margin is 18%. Revenue is amazing. Profit is a red X from Paul, but still very consistent. Amazing share decreasing. Amazing double assets over liabilities. Free cash flow is looking good, and price to free cash flow. Paul, what's wrong? Why would we not buy this company? Tell me about it.
Because PE is still 18, and for a company to be selling, historically PEs are around 15. So for a company to be selling 20% more than historical, I want to see some growth in there. There's no growth in this company.
Oh, come on, Paul. Of all the companies we've seen that are overvalued, how is this not a good buy?
Well, the other thing is, even though the price of free cash flow is less than 20, we still want to see it to be less than overall 50. So I look at this saying, these have all the metrics of a good company. Now it's just about price. Here's the good news. In April, at the end of March, we saw it below 120.
Mm-hmm.
I'm feeling like that's probably where you want to be buying the company. The great news is, from a long-term perspective.
Oh, look at that, Paul.
Sorry, 10 years.
Look at this, folks. Look at this.
So I'm looking at this going, guys, as recently as 5 years ago, when it was selling for, it had the same profit and same revenue, it was below $100.
Mm-hmm.
I think to myself, like, there'll be a time when, 7 years ago, there'll be a time when you look at it going, hey, 3M is a company you want. If you want to start building a position in it, fine. But at the same, what are you laughing about?
I'm just, Nicholas said, Paul wants 3M to be a grower and a shower.
That is true, Nick. By the way, I don't want them to be a grower, even though it's a funny statement.
Yes.
I don't care if a company is growing or not. I care about, can I pay the price that's adequate based on the future I think it has. If 3M makes $5 billion a year for the rest of the time, and I want a 10% return, I got to pay 5 divided by 10%, $50 billion. Things overpriced. The thing you guys got to remember is, to find the best value, you got to go to stocks that are ignored. You're going to find the best value in stocks that are ignored are the smaller companies worth $200-300 million.
Right.
Because nobody's following them. This company is followed by how many analysts? I mean, a ton of analysts. So this is going to be abused. It's owned by how many mutual funds? It's going to be used and abused. That's the unfortunate part about big companies. Is the great news about big companies, though, is when they do fall with the market, you can get really good value in stable companies that people are going to want to own and have to own as part of their mutual funds long term.
Paul, I'm still confused, and so are some of the viewers. We got so many great check marks on our 8 pillars. What's holding you back on this?
It's just price. I mean, I look at it going, we talk about the free price of free cash flow less than 20. That's great, but it's still only a 5% return on your money. You want better than that. You want to be able to because remember, they have to take that free cash flow and pay their dividend. So you're not, people will be like, well, Paul, but you're getting a 3% dividend too. Yeah, but you're using the free cash flow to pay for the dividend. My job as a value investor is to sit there and say, where can I get an above average return? At 95 billion, I'm not sitting there going, oh my God, this is terrible. Now I'm sitting there saying, oh, this is an obvious deal. I think it's probably worth $80 to $100 billion of the company. But as a value investor, I want to buy it for way lower than that. As a regular investor,
tell me,
maybe you're okay at $120, $130 a share.
Mm-hmm.
But I do think the market is overpriced right now significantly because of low interest rates. But financially, this is a very solid company financially.
Yeah, it looks great.
Yeah.
We wanted to look at DraftKings. I didn't even know this is a public company.
DraftKings is public. Guys, I'm going to tell you right now, I'm going to ruin it for you. DraftKings is probably massively overpriced. So why does DraftKings matter to us, Uncle Seth?
Well, so if you ever followed along the podcast, for the past 8 years, Paul has been developing an amazing and incredible game, which... well,
let's put the caveat in there. 8 years ago, I tried the game. It failed miserably. We just rebooted it a year and a half ago,
yes.
And it's gone phenomenally well.
So Dynasty Owner is a game that Paul devised. It is a fantasy football game, just like DraftKings, just like a FanDuel, all the stuff you see online, except ours is drastically different. It brings a few business side to this. Paul, I would never consider you much of a overly sports guy. You're not coming in and talking about your fantasy football or not much, but Paul's a businessman. So he made Dynasty Owner. We've had an amazing couple seasons.
I think I finished last place last year in our league.
Thousands of users who are actively using. So go to dynastyowner.com if you want to, in a new browser tab, of course, don't leave us, but in dynastyowner.com to check out our sort of sister company that we also have a podcast.
One of our subsidiaries.
Yeah, yes. One of our subsidiaries. So let's look at DraftKings. This is off the waiver wire.
Guys,
no pun intended. Oh my God, Paul.
Look at how much the stock is up just in the last year.
Why? Well,
think about it. Their comment was probably like, "Oh, people are," but I don't get that because there was no sports happening.
There's no sports. That's what I'm wondering.
Listen, this is going to be a very hyped up stock. So let's start it off the bat because I just want to sit there and do this.
So we're going to be looking at a stock you probably don't want to get at the moment.
PE.
This is PE ratio. We
less
want
than
this
zero.
less than 20.
Why? It's less than zero because they don't have profit.
Okay, that's
Profit margin,
that's-
negative 230%.
Oh God. Oh my God.
Okay, 2 big X's off the dribble. Next one.
Okay, revenue growth.
What the? They don't even have the income statement for this thing.
Oh, wow, look at that.
Let's look at the quarterly.
see.
It just went probably quarterly. Let's go to quarterly.
Revenue
Okay.
growth.
So quarterly,
Not much of a set.
this is 1 year to 1 year. This is, I mean, it's grown.
It's grown.
Guys, DraftKings is an X. We're not even gonna go further.
No need to.
Guys, I mean,
wait, Paul, clarify. It's an X for you. Why?
It doesn't make money. I don't even have financials on it. I can't even check it out. They don't have revenue numbers. They don't have anything here. I'm looking at going, you're basically going to buy this on the hopes and dreams that it becomes a bigger company. It's worth $21 billion. To me, if I'm going to pay $21 billion for a company, I can find a company that's going to generate good cash. I'd rather own 20% of 3M at 21 than own 100% of DraftKings, in my opinion. It's that sexy answer. But this is a company that could be worth 10 times more in 10 years. I don't know. But the point is they have a lot of growing to do. And if you gave me 100 DraftKings at these exact numbers and I invested in all 100, I'm going to lose money on the vast, but probably 95 of them.
So people are saying it's a new IPO, which is why the data is limited.
Yep.
They actually have someone saying they have some allegations of fraud. I mean, it's basically.
Oh, is that true?
Well, I don't know. Someone just saying
Seriously?
it. I mean, it is a gambling company. So, and someone else said that there were esports, which is, Paul, something we never discussed.
Yeah, esports.
The
is
video
cool.
games is
Listen, there's a lot of potential. There's a lot of potential for DraftKings. A lot of potential. But at the end of the day is, if you're willing to pay $21 billion, my comment would be, well, why not $200 billion? Well, that's ridiculous. Well, I think $21 billion is ridiculous because if it was $2 billion and I said $20 billion, you'd be like, oh, that's ridiculous. To me, it's all about a multiple of current present value of profit. I can't tell any of that stuff here. I can't tell how they can get the profitability. There's so many things, unknowns. I look at and go, why waste my time on DraftKings when there's 100 other companies I could probably look at that would be better buys?
So let me go back. If you're watching us and wondering what's wrong with this guy in these shorts, is like we're really talking about a long-term growth investment strategy, and Paul is very much like tortoise versus hare.
Yep.
He's going to make careful, calculated, disciplined
and the best investors of all time have done that, guys. I just go and emulate the best investors of all time. Like, what have they done? And it's slow and steady, and go against the grain. DraftKings is just the grain is. Let's just talk about it this way, guys. Look at DraftKings. Sports were shut down here. Shut down. I don't get that.
What does that tell you?
It just tells me there's a disconnect between reality and what's going on over here. Sports were shut down over there. Does that mean it should be shut down forever? No, but that's my point about how things can be irrational. That's not that's if you look at the present and say, oh, look at the sports were shut down, the stock goes up. I don't get that.
Off the request line, I'd like to pause for a moment of likeness.
Yeah.
If you're watching, we really can't thank you enough. I mean, I don't know if you're watching, if you can possibly imagine two grown men following our Facebook, our YouTube likes, like seventh grade girls. We text each other the numbers every morning, and we're literally treating. We're coming up on 1,500 subscribers, and we're literally treating this number like it might as well be 15 million. It's very important to us, and bringing Paul's knowledge to you. We just can't thank you enough for watching, and of course, smashing that like button right now, pretty please. We just love the support, and I love all the comments. So thanks so much. All right, Paul. Should we keep going? We have so many. There is a request for Broadcom. Someone in our chat says that their wife works for them.
For Broadcom?
Yeah. Oh. And someone said this content is worth a minimum of a like. Yeah, it's really easy. And Paul, as soon as I say that, our likes triple or our likes double. We appreciate that. We appreciate your help out there, guys. What is Broadcom? Don, do you have any? Don, do you know what this is? What is this?
Not off the top of my head, I do.
Paul, what is this? Tell me about it.
Radio frequency filters, amplifiers, and used in high-end smartphones such as Apple iPhone and Samsung Galaxy. So they have both. They create these transmitters for both major companies. That's a good thing.
Sounds confusing.
Connectivity chips that handle standards such as Wi-Fi. So they're obviously technology in phones and all these things. Wow, look at this rebound. It's doubled since the low.
Let me just stop. Someone had a great idea. If someone can forward us right in the comments, I know those Tesla red shorts.
Yeah, I'm not getting those.
You're wearing those nut huggers on the show. If we get to a certain number of likes, I guarantee you, not only will Paul and I be wrestling each other.
Likes or subscribers?
Subscribers. And you will be wearing the tight felt Hugh Hefner like Tesla red short shorts with your
He wears short shorts.
your man junk hanging out the front of it. That's gonna happen.
Okay.
Okay. So
So Broadcom has doubled. First off, PE ratio 70.
Broadcom, we're not doing well.
That sucks.
PE ratio
Profit
is
margin,
bad.
check, 11.8%, and the gross margin 57%, which means for every extra dollar they sell, they make 57 cents on that dollar. So started off with an X, and again, PE ratio being 70. I want to figure out why that is. It could be some
70. Good Lord.
Well, it could be some recent event that happened. They made a big write-off. That's why you guys always sit there and say it's not about looking at one individual metric. It's about looking at all of them together.
Okay. Pillar number 3 is revenue growth.
Let's go to revenue growth. I'm guessing it's probably not very high, but we will see. Let's go to annual.
We're all working from home right now. Right next to that like button in the bottom right corner, hit that share and
Holy
share this
cow.
with one of your friends who's just sitting around, probably doing nothing.
Oh my God, this
and
is
needs to be
insane.
watching us. What is this, Paul?
6.8,
Revenue
13.2, 17.6, 20.8, 22.6.
Wow, revenue is phenomenal.
Wow, a lot of revenue growth. Big check mark right there, kids.
Okay, how about profit growth? Pillar number 4, profit.
Profit.
I'm assuming this is pretty good, eh?
Okay, 1.3, lost $1.7 billion, 1.8, 12.6, 2.7. What the fudge? Huh.
What is going on here?
That's
They're
weird.
all over the map.
Yeah, they're all over the map. So it's a check, technically.
Oh, okay.
But it's weird because how did they make $12 billion? What did they sell? See, guys, this is the kind of stuff you want to look at and go, why is it all over the map here? And in the previous 5 years, they made 400 million, 500 million, 500 million, 500 million, 200 million, and then all of a sudden these huge numbers. They probably made some acquisition along the way in 2016 or 15 or 14 that allowed them. But why is 12.6 billion? They must have had something happen.
Paul, a lot of people want to see your whole portfolio. We'll have to open that up at one point.
Well, right now I only have 3% of my money in stocks. I don't know if I'll show the entire portfolio because there'll be some stocks that I have that are very low liquidity.
Are you afraid if you show how much money you have, people will dislike you?
No, I'm not worried about that at all.
Okay.
Remember, I don't have to show I don't have to show how much money I have to show my portfolio.
Okay. Pillar number 5 is number of shares outstanding. We want that decreasing.
Actually, knowing this country and YouTube, people probably like me more if I had more money.
Oh, okay.
All right, number 5.
Well, there is, Paul, I do think there's some validity to show that you absolutely. I follow some YouTube channels and these imbeciles like this. They use no data. It's just all hearsay. And they just tell all the viewers exactly what they want. Buy Tesla, buy Neo. And they're doing really well. And it pisses me off that we're taking this slow and steady path. You're very proud of it, but
I'm very proud of it. It's like the investing world.
You're right.
To me, that's just the way what makes sense to me.
Okay, go ahead. What were we
Number of
talking
shares
about?
outstanding.
Number of shares outstanding. Go for it.
Barf. 238 10 years ago, 398 now. In fairness, the last 3 years they've gone down, but it's still an X for me. They are trending down, but they've really increased a lot of their shares outstanding.
People also want to see my portfolio versus yours. I'm certain it's not as elaborate, but
well, yours is more elaborate than mine. All right, next one. Current assets greater than current liabilities. So they have enough money in the bank to pay off their current liabilities, their current debts. Total current assets, 13.7 billion. Current liabilities, 6.7. Plenty of money.
Great. Yeah,
check mark right there.
Okay, how about free cash flow growth?
Okay, so free cash flow first.
Cash from operations minus capital expenditures. That was really fast. Cash from operations, what are they making versus the expenditures? What do they owe? Bills.
Okay, so ready? Ooh, wow, this is impressive.
Now, Marcos is right. I do follow the magic formula. Paul, we probably should talk about that on a live. We will update you guys.
I have my own magic formula. So that's the thing we're going to get into a video.
Okay.
I have my own magic formula that I'm going to be investing 80% of my money into. And I will show you guys the last 23 years of returns on it. This is very important because I want everybody to see that this is why I like it so much, because it does poorly during times that are overpriced and does well during times that are not overpriced.
Yeah, so I am on the Magic Formula by Joel Greenblatt in the book, a little book that beats the market. And so I'll give you an update on that. I bought July 1. I bought 150 grand worth and using the formula, and we'll see how it goes.
Yep.
I'm assuming there's still gonna be like some big crash coming, Paul. So it's probably not gonna do well this year. But I'm all in. I am all in on this. So okay. What the hell are we doing, Paul?
So we're doing free cash flow.
Free cash flow, cash from operations minus capital expenditures.
Okay,
Let's do
so
it, baby.
1.7 billion. 2.7 billion.
So far, so good.
5.5 billion.
Mm-hmm.
8.2 billion. And then 9.2 billion. 9.2 billion.
Wait a minute, Paul.
Wow. Guys, that's big.
5 years.
So this is interesting. If you looked at their profit, it was all over the board, right?
Mm-hmm.
And now you look at their free cash flow and it's consistently growing.
Me likey.
Me likey too. So then the average over the last 5 years has been, what's the average? 4.4, 9.9, plus 8 is, so 10 plus 18 plus 9 is 27 divided by 5 is 5.4. So the average is 5.4 times 20 equal. Now this is why the times 20 is very important and good here.
This is pillar number 8. This is price to free cash flow. We won it less than 20.
Over the last 5 years, the average. And
Yes.
here's why this one's important. If it's more consistent, we want that average to be lower. If it jumps up big, like this is going, we want the average to be higher. So times 20 is $108 billion. So we want the company to be selling for less than $108 billion.
Drum roll, please. Is there a drum roll? Can we?
It's 150.
Uh-oh.
Okay, it's an uh-oh, but guys,
Look
at the disconnect here. And this is what's really important. I'm glad we talked about this company.
Go on.
The PE was 70.
Yes, very overvalued right off the bat.
Off the bat, if the historical average is 15, this needs to drop by, what is that, 80%, which means the stock value needs to drop to $30 billion. But on the price of free cash flow, we wanted $100 billion. So this is where profit and free cash flow disconnect. This is not a buy, but the free cash flow paints a better picture than the PE. I look at free cash flow more important than PE because free cash flow is supposed to be the cash actually coming in. Now, with the free cash flow, you saw the big jumps from 1.7 to 9 billion.
Yes.
This is not an immediate buy. None of these companies are ever going to be immediate buys off the 8 pillars. They're a good starting point.
Some could, right? No?
No, because you still have to understand. Listen, how everybody does their investing is up to them. For me, I'm not buying. I'm using the 8 pillars as my first, let's put everything in here and see what pops up in the 8 pillars. And from there, I go do more research.
But Paul, we have to understand our viewers are most likely not going to do this research to begin with. That's why they're here.
If you want to buy off the 8 pillars and only 8 pillars, I'm not going to stop you. I don't think that's the right thing to do, but it's a good way to go learn and get understanding of financials.
Can't you just tell me I'm poor? Just tell me what to do.
If you're poor, how are you buying stock? Although I will say we've had several tenants in the past who were on welfare who had rental properties.
How nice.
Explain that to me. Anyhow, the price of free cash flow tells me a much better story than the earnings, the PE ratio. So I'm actually going to disregard the PE ratio completely.
You're kidding.
No, I'm not kidding.
So if we disregard the PE ratio, we actually have green checks for all of it.
No, not all of it. The shares outstanding is bad.
No, shares was great.
No, it wasn't.
I missed it. X on that. Boom. If you're looking to host a podcast show, this position will be open very soon.
I'm looking for a new host, someone who pays attention.
It'll be the Paul and Don show very soon.
You wanted to be on the computer, respond to people, and this is why I was like, oh, he better pay attention still.
Well, I mean,
instead of flirting with all the guys out there.
Come on.
So either way, this is a great company to look at because how many people would tell you they're going to disregard PE? I'm disregarding PE here because I look at the price of free cash flow of being, great, and I'm like, okay, this is something that the stock still needs to fall, but the whole point is the PE doesn't tell the true story, and that's something you're learning different. You're going to learn different from us. We're not looking at one metric. We're looking at everything as a whole and saying, now, if you want an answer on this one, am I buying at this price? No. Would I have bought it in March? Yes. I regret not buying it in March. I would have bought it in March probably. Now, the good news is if you look at the 10-year history of the company, it's sold for very little pennies even 5 years. I mean, it sold for really great prices even 5 years ago.
Paul, we have lots of amazing comments. You guys are incredible. I love how you're smashing the likes, and we appreciate the support.
Keep smashing it.
We got a lot of suggestions.
What are the suggestions?
Tons of other companies, but this is a great one. This is John Sequincella. John just says, "What's a buy?"
What do you mean? What's a buy?
Well, we always do. We're not buying. I mean, show me something that we're going to buy. What stock is a buy right now? I guess, John, maybe Paul's answer is
Carnival Cruise Line.
Yes.
I bought Carnival Cruise Line. I think it's a long-term play. I own Carnival Cruise Line. I own Southwest.
What about Jets, the mutual fund? Jets?
The Jets mutual fund, I think, is probably okay for right now. I mean, I look at it going, guys, I'm I'm looking at things. The benefit of this channel and the negative of this channel is I'm very picky. So you're going to hear, Warren Buffett always says, your job is to say no as an investor. Your job isn't to find a reason to buy every stock. But Peter Lynch, who was a great successful investor, he bought thousands of stock at a time. And what he would do is he'd wait 3 or 4 months, see which ones perform well, and he did more research on, and then weed out the crappy ones. It's all about how you do it. Me, I bought Carnival Cruise Line. I bought gold companies, gold ETFs like GDX, GDXJ. Those have done very well for me. I bought Southwest. But Southwest has gone up in price, and I was hoping it would go down. I bought it 25. It's at 38 right now. Though Jets, I have some options on Jets. I have some options on Discover Financial. I'm not buying it at this price, but I have options to buy it at lower prices. These are things that I'm doing. I'm not telling you guys to go do it. In fact, don't do your own research. But these are the things that I'm buying. I'm not sitting here saying, no, there's no buys out there. I'm just sitting there saying, okay, we did eBay a few weeks ago, and I liked eBay. We did Intel. Intel went up from the time I was like, oh, shit, I kind of like it.
Ramon's asking, how do you do more research if you look at the company's 10K? Where do you suggest people go?
So 10K is all available on the SEC website. If you go to the SEC website, look up the 10K. It's a great question, Ramon. You have to read the 10K, and it's very boring. They're usually 100 to 200 pages long, but you'll get an idea. The company will give their notes on what the business is doing at that time in the company. I'm not telling you have to do that. In fact, I would sit there and say, have an understanding. You're going to learn a lot from reading. You know what you should start doing? Read Warren Buffett's annual letters from 1955 to now.
No one's going to do that, Paul.
Well, then why are we talking about this stuff? Guys, if we're here to learn how to invest in companies,
you're right.
You can't sit there and just say, I'm going to go buy a company off the whim.
That's true. I mean, listen, folks, I'm you. I need Paul in my life. I think the same dang thing.
You got really aggressive there.
Well, you're right. I just want you to tell me what to do instead of me doing the work. Isn't that everything about life?
Then you should buy ETFs.
Well, that's true.
But if you want 5 or 10% of your money into specific stocks, do some research on it. It's actually fun to do the research. And if your research is beyond the 8 pillars, and we're going to have an app that's going to do it, then great. We will show other ways, and I'm going to show you other things. But it's not like I'm not buying anything. I just don't have a lot of them. I'm trying to build a position in companies, guys.
Talk about your plans for the app you're thinking about, Paul.
So the app we're going to have is going to have many different things in it.
This is monumental, folks. Pay attention.
We're going to pay for a data feed that will be able to do the 8 pillars on every stock that's out there. So if you type in a ticker symbol, it'll do it. It'll do a real estate analysis for flips and for rentals. It'll have a loan calculator to do car and home loans. It will have it'll have a retirement calculator, how old you are, input the data, how much money you'll have in retirement, et cetera. So there's a lot of things it'll do. I'm just sitting there, and we're going to spend a lot of money creating it. I want it for you guys so you guys can learn more about the investing. I don't want people I want people on this channel. I want you guys to want to learn more. That's why you're here. You want to learn more. If it's just me giving you answers on what to do, there's 1,000 guys who will sit there and do that, and they'll probably be right over the line. They'll probably be wrong, but you won't notice it. I'm going to be as full disclosure as possible in all my investments, but you got to remember, a good investor isn't right all the time. A good investor is right 40 or 50% of the time. I'm doing Carnival Cruise Line, for example. Where's that stock gone?
Look it up real quick.
Let's look up Carnival Cruise Line.
Will the app have a Thirsty Programs asking, will the app have a divorce attorney? And how do you get a beard like me? You just let it go. And I roll brush at this in the morning, folks. So in a grand sense of femininity, I brush my beard with a roller brush in the morning. And it's quite embarrassing. Just the process of getting this beard looking like so powerful and just powerful really is the term, Paul.
Yeah.
Let's look at Carnival. Now, I bought this too after our video.
Of course you did.
Look at this, Paul. Look at us go.
Look at their profit margin, negative 600%. No PE. But I'm buying it. Yes. Why? Because it was
Tell the viewers again why.
It was a short-term, it's a short-term problem. I think it's the best funded, most likely to succeed, biggest cruise line.
Slow down. Say that again one more time. It's
most best funded. I think they have the money to withstand a year of no cruises. They're the biggest in the world. I don't think cruises are ever leaving. So I'm going to bet on the best finance company. But look at the stock. In the last 6 months, it's gone sideways. But I think it's worth $50, $60 a share when it finally turns around. Could I be wrong? Absolutely. Do I think Southwest is worth more than $38 a share when it goes back to market? I do, but you got to be patient. The problem with most investors, I want to teach you guys, is for us to be different, is your goal should be years down the road, not tomorrow, not today. Look at this. I felt like a genius here, right? And that was at $25 a share. Now it's at freaking $15 a share. So I've looked stupid, but I don't worry about that because I think it's worth 60 a share at some point. I'll call it 50 a share at some point. Now, if the pandemic hits another cycle and all of a sudden they can't survive, could I be wrong? Yeah, they could go much lower. I have bets on this company all the way up the board. I'm very confident with this, but I can do that because I'm patient. I'll have my friends text me and be like, Paul, look at Carnival. It's up 8% today. You know what I say? Okay. Don't care. Give me a call when it's at $50 a share. That's when I care.
Right off the crack, Paul, we definitely got at least 3 or 4 or 5 comments about people saying the app would probably be doing too much. Would you unbundle the app and just give us my dear brother-in-law Braden in Colorado says, yeah, we unbundle the app and just maybe slow it down a bit. So that's good feedback. Actually, they want just like one for the 8 pillars, an 8-pillar app.
Well, it's going to be, so you're telling me you'd rather have one app?
5 people are telling us that, Paul. Yes.
Really? Okay.
Okay. Now listen, folks, I want to get spicy here. We have so many requests here, Paul. I would say over and over, people are asking about Regeneron, which I don't know what that is. I wish I was in the know more about what Regeneron is. And also people, what is WSM? Is that Williams-Sonoma? Williams-Sonoma, is that WSN? Other people are asking for that. What is that? Anybody know?
WSN? Is that?
Maybe. What is that?
Oh, fudge.
I think in the future, folks, what we're going to do as well, to build the WSM, David says.
WSM.
M is in Mary, sorry. And RTX, we want to look at, whatever that is.
RTX. I know RTX.
Okay. Oh, this is the Williams-Sonoma. Okay.
Yeah,
great.
Williams-Sonoma. So this is retail, guys. I mean, this is
I would say in the future, Paul and I, in our natural life, we curse a lot. We have a lot of jokes, and we have to hold back on YouTube. So I think in the future, Paul, we're going to have a side sort of Paul and Seth time with a little more uncensored sort of, like a side show. We're going to have to develop that because we have to be too careful on YouTube. We can't say what we want, but we'll talk about Williams and Sonoma. Is it Williams? Is it Williams?
Williams-Sonoma.
Williams-Sonoma.
Okay.
Okay, let's talk. Pillar number 1, Paul.
PE 19. Okay, good check mark.
Pretty good.
Profit margin 9, X.
X on X.
Gross margin 37%, pretty good. So it's lower. I mean, retail tends to have lower bottom line margin because there's a lot of costs associated with it. The PE is a little high. I mean, I would tell you what the dribble. It's at all-time highs right now.
Yes.
With retail being pretty much dead.
And that's why people are asking about it,
Does that
right?
make sense?
So going back to your discipline approach, what do you think already?
I mean, that's already a red flag for me, but we'll see. Let's go to revenue growth. 5 billion, 5 billion, 5.3, 5.7, 5.9. So it's still a check mark there. I mean, I don't know how they're doing the online sales, but it's still a check mark there. Profit growth.
Yeah, profit growth.
310, 305, 260, 333, 356. So it's growing. Another check mark there.
Revenue shares outstanding. Are they going down?
Number of shares outstanding.
What am I saying? Number of shares outstanding.
107 down to 78. Check mark there.
Oh, I like that one. How about
we have all check mark? No, the profit margin was an X, but it wasn't bad.
9%. Yeah.
Yep, that's fine.
How about current assets greater than current liabilities? Pillar number 6.
Okay. Most recent quarter. Now, total current assets, 2.25 billion. Total current liabilities, 1.66. So we have a check mark there too, as of right this very second. Let me see if that's consistent over the past. Yeah, it's pretty consistent. Good. With retail. Let's see. Yeah, it's pretty impressive. Okay. So they're pretty consistent, being more current assets greater than current liabilities. A company like this is going to have a lot of inventory. Their inventory is 40% of almost 40% of their current assets. It's actually a little over. So keep that in mind. If they were ever had to go bankrupt, they're not going to get the full value of the inventory. But the point is, they still have more current assets than current liabilities.
How about free cash flow growth?
Okay, free cash flow.
Cash from operations minus capital expenditures.
Yes. Now, the last full year, we're not including the pandemic time. The last full year. So 340. 325.
Again, Paul, people can't get enough of your nut hugging shorts. How it cups your butt cheeks.
These are not nut hugging shorts.
How it cups your butt cheeks ever so gently. The camel color.
420 or something. So it is a check mark here. It's growing its free cash flow, not including the pandemic. It is growing its free cash flow.
Price to free cash flow
I
average.
just forgot. Oh, sorry, not the F word.
price to free
I just
cash
deleted
flow.
this. So this is
Let him go again.
40.
While Paul's rewriting this, make sure you smash that like button. We love you. If
25.
there's 46 of you watching now, I love you. And if there's only 28 likes, if you just please just
Only 28 likes on 50 people?
Paul, don't get upset. Paul,
Guys,
Paul,
come on.
keep the positivity up. They're just gonna smash that like button right now, and then the likes gonna go up, and you're gonna get your fix,
400.
your drug fix of likes, Paul. You'll get that.
Isn't it pathetic? 510. So 340, 665, 975, 1375, 1885.
You need a
divided
calculator.
by 5 equals 363.
1885
divided by 5, 360.
377.
Oh, damn it.
Come on.
377
Mm-hmm.
times. Now this one is retail. We usually want less than 20. I'm gonna want way less than 20. You guys, you're not gonna like this. I want less than 10. And here's the reason why, guys. Retail is gonna have a very tough future. You have to understand how this company is going to change for the future. It's going to be less foot traffic. It's going to be more online sales. I just bought from Williams-Sonoma recently online. So I want it to be I want the company to be selling for less than $3.8 billion right now for me to really like it.
3.8 bill.
Yeah, let's see what it's at right now.
Paul. It's an all-time high.
Yeah, 7.7.
Twice.
Yep, twice that. But guys, I'm not trying to be a jerk here, but it's retail. Now, does that mean I need to get it at 3.7? No, it'll probably be a good buy at a lower price than that. But 7.7 is way too high for retail, in my opinion. 20 times free cash flow over the last 5 years. That's way too high for a company like this. It's over double. Like this is a. I will say this, in the retail world, this has a good brand. I like this company, but you need to buy it at a lot cheaper price.
So someone just mentioned, and I think we've analyzed Dick's Sporting Goods in the past.
Yep.
Someone said Foot Locker is doing great with retail. Now, I think.
By the way, I have Foot Locker stock. I forgot about that.
Oh, tell us, Paul.
I don't know what I bought Foot Locker at though. I have to go back and look at it.
Look,
because I like their brand, and I didn't buy a lot though because I think I still think this is an issue, but I do like their I do like the stock.
In the end, I have to try on shoes. I will not order shoes.
Well, that's not true.
Online, you will?
Yeah.
And you send them back.
You can return.
Yeah, it's hard to return.
You have a wife.
Ain't nobody got time for that.
You have a wife.
All right. Well, when did you buy Foot Locker? Tell me about
$20 some dollars a share. I want to say it was like $25, $26 a share. So I've done well with it, but I'm not. I don't remember what I thought it was worth. Crap. I have to go back and look.
Okay.
But either way, I do have Foot Locker. I'm glad somebody brought up Foot Locker because I like their financials. I did like their financials.
Can we look at Regeneron?
Regeneron.
Don, do you know the ticker? Anyone know Don, do you know the ticker for Regeneron?
I do not.
Is it RTX? That's it. Is it RTX?
No, RTX is I forget what RTX is, but
people are asking for RTX. Some of our OG homies are. Oh, Matt got it. REG.
Oh my lord, Matt. Who? My Matt?
Yeah, you're Matt.
My Matt?
You're Maddie. You're little Maddie.
He's such a good supporter. All right, Regeneron.
What is this? Wait, stop. What is this company? I've never
Pharmaceuticals.
Oh, of course.
So remember about pharmaceutical, guys. It's all about what's in the pipeline, what's expiring on patent. So you have to make sure you understand that.
Okay.
23 times PE. X.
Not too bad though, Paul. Come on.
Well, it all depends on. Okay. Remember, in and of itself, we don't know.
PE, price to earnings. We want it under 20. It's not. Okay.
Look at this profit margin.
Profit margin number 2. Margin profit.
46%.
Oh, come on.
It's huge. Their gross margins 80, but that happens because after you make a pill, how much does it cost you to make the pill?
Revenue growth, pillar number 3.
Oh, you're not going to let me talk.
Nope. Go.
Dick.
Oh, it's a new COVID drug. People are saying.
Oh, is that what it is?
Oh, and Marco is asking for Cisco, which is in the magic formula. So I probably Cisco.
4 billion, 4.7, 5.5, 6.3, 7.45. Chickadee check.
Great revenue growth.
Profit growth.
Profit growth.
636, 895, 1.2, 2.4, 2.1. Check. It did dip in the last year, but that's definitely still a check there.
Okay. Number of shares outstanding. Pillar number 5.
Oh, there we go. Number of shares outstanding.
I'm glad you're flying through this. What's wrong, Paul? Oh, no.
83, 90, 95, 98, 100, 103, 104, 106, 108, 109. It literally goes up every single year.
Why is that? What are they doing?
X. They're probably using it to fund something, make acquisitions. I don't know. But the bottom line is, when you buy, the history has shown that when you buy, they're gonna devalue your shares over the future.
No good, right?
I don't like that. That's just not a good thing for me to see.
How about current assets greater than current liabilities?
Let's do this.
How much of this pillar, assets over liabilities, goes in your mind of like, is this more of like, can they withstand a
Yeah, I want to see, like, do they have the money in hand to be able to, does it withstand like a blip in the business? 7.9 billion. A lot of that is inventory, but that doesn't matter. 7.9 billion versus 3.7. Massive
owner
check mark.
Oh, check mark. Okay.
Massive check mark. That's a good
Okay.
one.
Okay. Sorry, I was
In fact,
quick to the jump
in
there.
fact, this is a massive check mark. This is all over the board check mark. I'm going to go even further, guys.
Go on.
They have more cash on hand than all their debts.
Oh, tell me about that.
That means, folks, you would have more money in your checking account.
your
You can pay off your house, your car, your everything you have just in your checking account.
And your monthly payment to the Everything Money app, which is coming. When is it coming, Paul? Next year.
Next 12 to 18 months, we'll see.
Okay.
It takes a lot of time and money to build these apps. This app will probably cost me $50,000 to $100,000 to build, plus $2,000 or $3,000 a month to operate.
Well,
Easily.
people are wondering about Regeneron because Trump has stock in it. Oh, that's why he's saying
I'm not going to buy it just because Trump has stock
he
in it.
loves the new cocktail they gave him this weekend. Yada yada yada.
Yada. Don't care.
Okay, price to free cash flow growth. Did we do? No, we
700,
just did.
900 million, 1 billion, 1.8 billion, 2 billion. Massive check mark. Guys, this is good. Now, the average, 1.6. This is a fast growing company times 20 equals 25.6 billion dollars. Did I get that right? What's 1.28 times 20? 25.6?
25.6 exactly.
Okay.
You son of a
Oh,
bitch.
please let me be 25.6 or lower.
Don't scream now. Just be careful.
Nope, not even close. $63 billion. Guys,
Triple. What's wrong?
this is a
Paul?
very, very common issue.
Give it to me.
Great company, great financials, in the news a lot, skyrockets in price. Not worth it.
Not worth.
It's just, I shouldn't say not worth it. You have to expect, to be able to justify this market cap, you have to get massive growth over the next few years. We don't have the model in there right now to be able to pull it up, but you have to expect, and one of the things we'll do is we're going to have the app, when I have my laptop here, we're going to be able to put the model in and see how much does revenue have to grow and profit to grow in order to justify that. Guys, everything else in this company was phenomenal, but you can have a great company at a bad price. This is a prime example. Great company, bad price. Great financials, bad price.
Okay, hold on a second. I'm confused though.
Yes.
I really am. I've been doing this show for a long time, and maybe you talked about this last episode. In my mind, if it's a great company, I just need to buy this stock and then have the stock increase in the future, and I make money, right, Paul?
But so really,
theory, it comes down to, is that going to happen? Or
in that theory, then what price are you willing to pay? According to your theory right there, pay any price. Because if it's a great company and that's all that matters, then every great company should have an infinite price. Why wouldn't it?
Oh, you're right here. I got the crickets on my own self now because
that's the thing. You're right in the sense of a great company, I should want to own it. But then what you're saying there is at any price. And so far, Tesla and Amazon have looked like, at any price, it's worked out. But then I sit there and say, if Tesla is such a great company, why not pay $100,000 a share, $1 million a share? Well, Paul, it's ridiculous. Well, why is it ridiculous? It's a great company. If all that matters is it's a great company, then the same thing as the Michael Jordan conversation. He's the greatest ever because he has 6 championships. Great. Robert Horry has 7.
Yes.
If it's just a great company, it doesn't matter.
You're right.
But it does matter because at the end of the day, how do you get paid back as an investor? By revenue and profit going up.
Really? Because I thought it was just stock price going up.
But what drives stock price over the long run? Over the long run, guys, everything over the long run is based on
boom.
It's based on revenue, profit, and fundamentals of a company. At the end of the day, that's all that matters. Short term, no. Look at this company. In 1 year,
look at this.
Here, look at that.
In 1 year, this company was $250, $280 a share, and now it's $588.
Doubled?
Oh, more than doubled.
Oh boy.
Right? So you sit there and say, okay, I'm not saying I'm right. I'm just sitting there saying this is a great fundamental company, guys. Like literally, whoever brought it up to us, Great find. Fundamentals, everything is there. It's just the price is out of whack.
All right. One of our followers, Benjamin, has written RTX Raytheon. He's literally written it 17 times, and we appreciate your support. I love you. Thanks for helping us, and we're going to get to it right meow. Right meow. RTX. What is Raytheon? I can't follow this stuff, Paul. I'm too busy following magic cards. And
I believe they're they do government shit, crap stuff.
is it
Okay, let's see.
diversified aerospace?
Defense industrial company. Okay.
I need to call these guys and sell them my product,
Yes, you
DGF.
do.
Go to dgfspray.com, dgfspray.com for your
Pay for
dry
that
lubricant.
endorsement?
Did I? You're paying me for it.
All right, ready? PE ratio, negative. They don't make money. They haven't made money.
Well, okay.
Profit
but it's
margin, negative
exciting.
27. Here's what I don't like about Raytheon. Ready?
Go on.
Their gross margin is 13%. That's pretty low. That means for every new contract they sell, they only bring 13% of the bottom line, and that's before overhead costs. That's not good. So off the bat, guys, I'm not saying no automatically yet, but this is not a good start.
Okay.
Financials.
Revenue growth.
Revenue growth. Oh, substantial revenue growth.
Show it to me.
56, 57, 60, 66, 77. Boom. Good revenue growth. Check mark there. Boom. Check
Boom.
mark.
Okay. How about profit growth?
Profit.
Pillar number 4.
7.6, 5, 4.5, 5.26, 5.5. Technically an X, but it's not bad. It's not a bad X. This is fine. It's a big company. They've been consistent in the past. They make good money. I wonder what they did, what happened recently. Okay, shares outstanding.
Number of shares.
10 years ago, 850 this year, but in the years it's been going up. So it's technically still a check mark, but it's kind of a check mark. Don't know yet.
Everybody wants to do CVS, Paul.
Well, I get that, but we
including
only
my
have
10-year-old.
8 more minutes.
Well,
I'm
not,
flying through this stuff.
not necessarily. The
42
people,
billion in current assets.
assets over liabilities. Pillar
Check
number
mark. 42 billion versus 35 billion. They have a check mark there. So they have
Wow,
more money
okay.
on hand than current liabilities.
Free cash flow.
Free cash flow.
Get in the flow.
I lay the check. You lock the flow.
Free cash flow is cash from operations minus capital expenditures.
4.3, 1.8, 3.3, 4.3, 4, I mean, sorry, 4.0, and 6.2.
What do you think?
Check.
Okay.
Average, 6.1, 9.4, 13.4, 19.6 divided by 5 is 3.9, right? Times
3.92.
equals $80 billion roughly.
Now don't freak out now, Paul. You always tend to.
$80 billion, drum roll please, 91, not terrible.
Uh-oh.
Now, guys, why are they losing money though in the last few quarters? This is part of the issue.
Well,
They've
let's
lost
see
money
here.
in the last few quarters.
Now they're did they merge? Did they merge? What is
merged.
going on out there?
I don't think that has anything to do with it. So guys, their revenue is up a lot in the last year. 14 billion versus 11. For some reason, their income has dropped. They had a big write-off or something.
Benjamin, right? The fan that wanted this, I love you. Ben, will you write why you and love this in the comments, and I'll relay it to Paul.
They lost 3.8 billion this last quarter. They had a big write-off somewhere.
What do you think happened?
Well, they wrote something off big. Like maybe they had a bad deal. Like right here, other income and expenses, they lost 2.9 billion. So good example of a company that could very well be okay.
Oh, government contracts, he says.
So that's the thing about low margins. If they lost some government contracts, they got to write those off. That's bad. Because that's a $4 billion write-off, guys. If you're making this is a 1 year of gone money.
I mean, again, I say, Paul, will you go back, look? So again, I'm stupidly looking at the stock. It looks like it's like, if we have some check marks and things aren't that bad.
Let me ask you a question, Seth. Okay, CVS, sorry guys, I'm not going to do CVS today, but here's why.
See, this is me, Paul. This is me going right back to,
Right.
I just want to find a reason to buy.
Let's
and you're
talk.
saying that Warren Buffett tells me the reason I should find reasons
Let's
not
talk.
to buy. Go on, tell it to me. Oh, he says there's government contracts, technology and weapons,
Good.
and no more tanks and machine guns. Think lasers and missiles like Dr. Evil, Paul. You kind of look like Dr. Evil. a
I
little
do
bit
kinda
on
look
the-
like Dr. Evil.
Yeah.
Okay, this might go a little bit longer than our 1 hour. 10, 9, 8, 7, 6.
Oh, you got a big graph here now. Look at all these numbers.
Where's the graph? What's the graph?
I mean, what are you doing here? What is all this?
Okay, so
Go for it.
income, Let's go 3.
Paul's checking Grinder on his phone in between during. That's why he steps over to the
2.5
podium.
to 1.51.
Is Grinder a thing still?
I don't know. So revenue, let's say you have years 1 through 5. Revenue is decreasing here, right? Income is decreasing. So I told you in the next 5 years, this company is losing revenue, losing profit. Would you not pay something to get 5 years of profit equaling 5.5, 7.5, $10 billion? They're going to make, a company's going to make 10. If I told you for sure, a company's going to make $10 billion in the next 5 years, and then it's going to go to nothing, what would you pay for that company today?
I have no idea. That's why I'm watching your
Would
show.
you pay more 10 billion or less than 10 billion?
I see. I would not want to pay more. I'd want to pay less.
Because you're going to go to
As
zero.
always,
So
right.
let's say you pay 5 billion and you can get 10 billion. You doubled your money in 5 years. That's a 17, 18, that's a 15% return on your money, right?
Are these Raytheon numbers or what?
No, I'm just making this up.
Okay, sorry, go on.
This is a company that's losing value. Just because it's losing value doesn't mean that it's not worth something.
Oh, okay.
That is my point. My point is it can still be losing value and doing things that's not worth something. But the question is, how much is that worth? Just like a company, if it was going the other way, if it was going this way, according to everybody in the public, oh, look how much it's growing. It's tripled in the next 5 years. I'm going to pay a ton. You still have a price to pay for that future. All you're doing as an investor is trying to decide how much are you willing to pay to get a future stream of income and cash flow. That's all we're trying to do. You're going to make assumptions. But if your assumptions are based on crazy numbers, it can justify the price today, but you have to assume that all those assumptions are hit. The one thing we've learned about the world is that you don't know what's going to happen in the next 5 years. And there are 10,000 stocks out there. More than that. There are 30,000 stocks out there. All I'm asking you to do as an investor is to find 30 or 40 of them.
Yes.
Where if you make really low assumptions, you can still buy them for cheap values. And that's all we're doing here. I'm asking you to find 1 in every 1,000 companies. 1 in 1,000. If you don't want to do that, ETFs are a great way to go because you're just going to bet on the market and it'll go up over long periods of time. And I'm fine with that. But if you want to go do the nitty gritty, I'm asking you to research. I research 100 stocks before I find 1 or 2 that I like.
The same thing for real estate. You told me. Look at
Same
100
thing for real
houses
estate.
before you find the one house.
Just like my shorts. I go look at how many shorts before I find the pair. I'm like, this is the one. It's not exciting because you guys want to buy.
You were blindfolded when you're looking at these shorts. I wore shorts today too for you. In one of these shows, Paul and I are going to switch positions, and I'll be up there yapping away.
The difference is I'm going to wear his clothes and his size. He's going to wear my clothes and my size.
That's a funny episode, Paul.
Guys, I'm trying to teach you guys, and you guys, bless you. You're here to learn because you want to understand how to look at companies. I want to change your way of thinking from what everybody else says out there to the right way of thinking, which is if everybody thinks something, it probably isn't true in the world of investing, or it's exaggerated on the good and the bad. I think Carnival Cruise Line is exaggerated to the downside.
Mm-hmm.
I thought Southwest at $25 was exaggerated to the downside. I thought Foot Locker at $25 was exaggerated to the downside. I thought gold was miners were exaggerated to the down. These are the things I'm trying to do. Remember, emotion will change the view of the world drastically in both directions. There'll be a time when stocks fall so much, everybody goes, you shouldn't even own stocks. And Uncle Paul will be here to tell you, no, you should own stocks, and here's why. Remember how Raytheon was worth, 91 billion at that time?
Yeah, 60 billion.
91 billion, it was the market cap. I wanted to buy it at 80, and it'll be selling for 40. And you'll be like, Paul, how can it be selling at 40 when you say it's worth 80? That's what's going to happen. It always does. It happens unless they're worth at some point. This will happen, guys. It's happened so many times in the past, I can guarantee it. But you have to be patient. In the meantime, you want to have some fun and dabble in some stocks, go for it. But be ready to don't put the majority of your money in there, put a small portion, and just be smart about it. Have fun with it.
We will have to save CVS for its own video. We want to talk about that. We'll publish it on the channel.
We are done.
People are asking for Exxon. Oil gotten crushed this year, down 40% oil. Do you want to fly through Exxon or you want to?
Nope, I think we're done. It's been 1 hour. I want to keep it to the hour.
Wow.
You have another live podcast in 1 hour for Dynasty Owner.
Wow. Thank you guys and gals. The 3% gals who are watching for really my sex appeal and Paul's moose knuckle. We thank you from the bottom of our hearts, whatever that means. The Everything Money channel. Paul, we've been at this 2 years. October is when we started this, 2018.
Yes, but we didn't focus on YouTube until the last 8 or 9 months.
I know, but you and I were sitting at this table talking about a lot of things.
We were.
And now a lot of people are watching us, and it's just it's very nice.
And ironically, we started with real estate, and I understand why real estate isn't as fun, because stocks are every single day. Real estate doesn't change much over a long period, over day to days, but stocks do.
Again, I share this with a friend. It creates great banter. Listening to my Uncle Paul, I'm that guy that will start arguing about Tesla stock in random rooms. So you can be that guy or gal too, if you want to have a very disciplined approach. And I would say, Paul, your disciplined approach has brought a lot of a little more inner peace for me, knowing that if I just invest in my ETFs, my sort of playing it safe, I can still have a wonderful retirement with millions of dollars.
I'm not trying to be Babe Ruth. I'm trying to be Pete Rose, except without the whole banning from the Hall of Fame. Babe Ruth hit a lot of home runs, but he struck out a lot. I personally am trying to be Pete Rose, which get a lot of hits.
It's a great way to put it.
Yep. I'm Billy Bean from Moneyball.
Thanks everyone for watching. Join us next Tuesday at 11 a.m. Eastern, and we might be moving this time a little more in the coming weeks. We might be moving in more in the afternoon, so we can get
We'll give plenty of warning. The other thing is, I'm going to start bringing in technical analysis into all these stocks too, so we can sit there and look at charts and say, hey, there might be momentum here, might be negative, might be positive, etc. All right.
Thanks everyone for watching.
Thanks, guys.
Everything Money. See you.